Welcome to the Twomey Stock Market Report. Today's a recap for January 4th, 2023. And I'm James Twomey. Want to get you up to date on what's happening in the 2023 year start. And let's get right to it. What we're seeing is quite a few things. Number one, we had the Fed notes come out today. No surprise. They are still on the path of saying inflation is number one. It is still a problem. They do see them going to nearing more 5 to 5.4, maybe 5.5% by sometime in 2023 on rates. Even though it's going to be smaller rate increases, the next one's going to be mid-February. They're indicating inflation is not going away. Will it taper off month over month, year over year? Yes, but it appears we're going to be at higher elevated inflation for the rest of 2023. The target fund rate of 2% is well off. The only way we're going to get near there by 2023 is if we have a major recession. And that does not bode really well either way. Let's assume that we have a major recession, stock market collapses, economy collapses. Yes, you could probably get inflation way down because demand just evaporates. But right now, what's happening is we're in a reactive trading phase. The market recognizes, stock market that is, and traders, that it's going to be tremendous headwinds for companies to show profits. Their costs are going to continue to increase, and the cost of labor is going to continue to increase. The Fed's trying to put enough. They've kind of worked on the car market as far as, car loans and cars and all that stuff. With the, it's really put a kibosh on the car sales. Real estate, same way, increased rates. It's harder to afford a home, harder to qualify for 6% mortgages, you name it. What they're trying to do is get the economy slowing down from a job perspective. That's harder to do. Why? The Fed is just the Fed. Washington and Congress and the Senate, they're plowing money into the economy through the infrastructure bills, the Green Bill or the Inflation Protection Act, the CHIPS bill, the infrastructure. Today, McConnell and Biden are getting together to talk some bridge in Kentucky, $1 billion that were appropriated to replace a bridge. Hey, that's great. Infrastructure needs to be fixed. Perfect. Money needs to be spent to make that happen. It usually comes from the government versus private, right? The only problem is once that stops, it doesn't really create innovation and productivity. It just, the spigot turns off and people are out of work. It also, it looks like the ones that right now are being, Salesforce just announced layoffs, fairly large amount. It seems like high tech is the one that's not benefiting from the CHIPS bill just yet, nor the infrastructure, nor the inflation green bill. So what's happening there, it could be a high tech recession where higher wage earners lose their jobs, lower to middle class retain, government, state workers retain. They keep the economy flowing. They afford the extra cost of inflation, and we really don't evaporate inflation. That's bad for the stock market. That's what we're seeing. So what it's causing is reactive trading zones. We're seeing this, and it's hard to tell the last month of the year and into January. There's all kinds of sentiment going on. Right now, it is safe to say that we're in a trading range and things are not going to move dramatically. People will get caught once more in bear market rallies. We had one a month and a half ago. We got caught in that as well on the updraft and couldn't get out fast enough because it dropped, 4 or 5% in a day. So, that's the problem. It gets run up. The pundits go, oh, the Fed's not going to raise rates, inflation's not coming, and boom, they pull the rug out. So it's a very reactive trading. As soon as you go long, the market drops. As soon as you go short, the market goes up. So that's what we call reactive trading. That's a space we do not want to reside. So I want to today take a look at a couple of things. Our 4 tenets of recession, we go over this all the time. Inverted yield curve, that's been going on all of 2022. That stress on the economy where lower rates are pay higher than um, longer term rates, yields, and it causes all kinds of market stress, financial stress, borrowing stress. That's been going on and off. Two negative GDP technically is a recession. We had two last year, it reversed, and it looks like now we're going to have a fairly positive second quarter. The last quarter of 2022, making two positive quarters in a row. So that's off the table. PMI below 50 is a recession tenet. It is below 50. That means people are not building as much inventory. That means lack of supplies are going to be required, not lack, but it's going to require less supplies because manufacturers aren't building supply, aren't building inventory. They're not in business to pay for inventory. So that will definitely slow. That means the economy is slowing. That'll ultimately, if it continues, that will ultimately cause layoffs. Now, expanding unemployment. We're on watch for that. Quite frankly, I'm going to take the negative GDP off the table for now. It looks like inverted yield curve, PMI, if that continues, and if we start getting an uptick in unemployment the next 30 to 60 days, then that could be catastrophic to this economy. What do I mean by economy? It's going to slow down the ability for people to buy products, groceries, gas, pay their heating bills. I know many of you have emailed me. Electric bills, gas bills, oil bills have more than doubled, in some cases tripled. And it's just, even people who have good jobs and working just can't make ends meet, and they're cutting everywhere. So that's going to be terrible. Will the stimulus that the government has put in, billions of dollars, will that override any layoffs? Right now, it has. It has the end of last year, and it looks like it could continue. So if that's the case, inflation's here for a long time. It's going to be a stagflation type scenario. We're not going to get much growth. It's going to be a situation where people have to pull in their horns. So let's go right to our charts from a technical perspective. I want to look at TBT. We're shorting the 20-year Treasury bonds, TBT. This is the 200% played. TBF would be the 1-to-1. We are still short, but we've hit below our two 1/3 and 2/3 stops, which is the 9 and over here the 15 EMA. And then now the 20 EMA, we're also below that. These are exponential moving averages. We are getting near our buy signal, so we're quickly in the last 3 days, trading days, wiped out about half of our gains. So we're on watch there. Will it rebound? Right now, we don't have a sell signal. This is the tricky part of reactive trading. There's a lot of pressure, a lot of back and forth. We've broken the Twomey trend track line here, this blue line. So we've got to, the next day or two, we're going to see where this trades, but it needs to stop here technically and rebound and start getting some buying. With the Fed's notes that came out today, it may bring rates back to the yields rise. So this is when bonds pay higher interest rates, TBT goes up. TLT is the opposite, which we were along, and we took our profits 6, 7, 8% in some cases and got out. And you can see here, this is just broke the Twomey trend track line. We still do not have a buy signal, not on the only thing is the stochastics are moving. They're not in positive really per se. It's 35 on the green, but they have crossed positive, green over red. MACD is still negative. So we got a long ways to go. We're not even, looking at that as right yet. And so we're keeping an eye on that. The other thing we're short, the NASDAQ. Let's take a look at that. We use PSQ, which is a 1-to-1. And same thing. It's just hugging our 9 EMA, which is near our first 1/3 stop. And then we've got quite a bit of gap between the 14 and the 9 and the 20 EMA here in green. Very healthy, even though it's pulled back the last 5 trading days. We're going to have to see it's eclipsing. This is a great example. It's coming into the Twomey trend track line, very narrow trend track line. So, the market doesn't know anything about our track line, but we use it as our guardrail. So from we've got our buy signal. We've had our buy signal for quite some time. It's back here on December 15th or so. And, we get fits and starts, and that's what we're getting. But the RSI today is 57.95, not oversold. That would be towards high 60s, 70s. So we've got a chance for this to flatten out for the next couple of days and run. We are going to see a lot of reactive trading. And you have to be patient for that. We may have to, unfortunately, take some stops and tighten them and get out early and then get back in. That's not something we like to do. But until an overall trend starts forming in January, we have to be cautious. We had some energy plays. They have been stopped out in some cases. Others are look at this. XLE was one of our plays, and that is just hit a sell signal today. So we're going to be issuing to our subscribers a sell signal, and we want to get out of that to protect any further downtrend. And this is what's we got a buy signal. It lasted a very short amount of time. So this is what happens in reactive trading. We took a little bit of a risk on that to get in earlier than we should have, but that was all on the premise that the U.S. is now buying oil to refill the strategic reserve, putting a baseline into the U.S. oil. Well, that should be in the mid-60s. Well, let's look at United States oil, and lo and behold, look at this huge downdraft. That tells you a couple of things. One is either we've had a warming trend, there's excess supplies, which is not really the case, and or the demand is really faltering. Which, if that's the case, that is a worldwide type situation. And if that's the case, it really is interesting because supposedly we've curtailed the Russian oil to Europe. I mean, even though we supplied and everyone else supplied Europe with 3 months worth basically of oil, natural gas to get through the winter, it still has to get used. Once it gets used, Russia's not filling it up. Well, come to find out last week, there is some caveats to that where Germany and a few other, Poland, are all now still buying Russian oil through, it's in our market report. I put it in the what the experts are saying. I won't waste your time here, but go to the Twomey stock market report from last week. It has all that information. And lo and behold, this is not a politic comment, but we put in these sanctions, we tell people what we're going to do, and there's backdoor traps that erase all those, and all of a sudden, the Russian oil is flowing somewhere else. And, oil's out there. We also, Chevron has filled up 2 tankers from Venezuela. So it's a future commodity type trade. It looks like we're going to go through some slogging on the the technical terms. So technically, it looks like we're going to be getting out of U.S. oil as well. But we're going to give it another day and see if it rebounds. Oil is tough because it does have a lot of volatility day to day. So that's the Twomey stock market report. I want to leave you with a couple of things. Fundamentally, nothing's really changed. Inflation's here for the better part of 2023. We are going to be facing interest rates at 5.5% most likely through eventually and rest of the year. Will the Fed pivot? It's not going to happen. You're going to hear that talk the next 3 months. They're not going to pivot. We are back. Are we going to be in a 70s type scenario? Probably not, but we're going to be more back in the Obama area where it was low growth, low GDP, stagflation, not a lot of innovation, a lot of government regulations curtailing innovation. And we're going to have stimulus money being thrown out the door to, to buy votes, if you will, quote unquote, not to be political, but, and it's going to be more towards the union sector. Nothing wrong with that. So that's where we want to keep our eyes. We've tried to look into materials sector and industrial sector, U.S. Steel, a few others. We've gotten some pluses and minuses. It hasn't really hit. So anyways, this week we're going to probably be alerting our subscribers on a couple of trades. We are looking more to get through this reactive phase. We've got a couple of plays that have high dividends, 15-16% that we're playing. So we want to keep those on the forefront for you. We're going to make some money. It may be a while before we get a nice ride, but and ride a long-term trend. But for now, there's no rush for us to go long or very deep because we're just going to get caught in a bear market rally. So that's the Twomey Stock Market Report. Go to the number 2, mestocks.com. There you can get our trade tracker. You can get our newsletter, our videos, our alerts. Sign up for them. You get them right to your news desk, your news desk. All our news comes right to your email in real time. You can make the trades right away. We do all the stops for you, and then you take it from there. You make the profits as we do the work. I'm James Twomey. Today is Wednesday, January 4th, 2023. Thank you.